The top business stories live from the Sky News City studio. The city regulator finds no evidence that banks are closing accounts on the basis of customers' personal views. We'll have the latest from New York Climate Week as companies are urged to sign up to Biodiversity Credits to invest in nature restoration. Plus, American car workers are set to step up their strike action as their walkout moves into a fifth day. Good afternoon, this is Business Live with me, Ian King. The city regulator says there's no evidence that banks are closing accounts on the basis of customers' personal views. The Financial Conduct Authority has been investigating the so-called debanking row that engulfed NatWest Group following a complaint from the former UKIP leader, Nigel Farage. Well, today, the FCA said that no bank or building society or payment firm had reported that they had closed accounts primarily due to someone's political views, but it admitted that there was still work to be done to investigate the issue.
So far, we have not identified any closures that have actually happened on the basis of lawfully held political views. What I'm also saying, though, is in this category of closures because of reputational risk, we need to do some further work.
Well, with me now is Laura Noonan. She's the Financial Regulation Editor at the Financial Times. Laura, good to see you this afternoon. I mean, the FCA stressed that this report was carried out at speed. That rather sounds like they're trying to apologise for the fact that they haven't found any evidence for this.
It's a bit of a mixed bag. I mean, I think the FCA is very conscious there's a lot that the FCA doesn't actually know here. So what the FCA did was, back in August, around August 8th, they went out and they asked 34 banks, billing societies and payments companies for information about why they had closed accounts and why they had refused accounts. And this is basically a summary of all the information that they got back. But they're very much price takers here. They haven't really audited this in any kind of deliberate way. They just asked the banks the questions and the building societies and the payments firms, and they've given them the answers. And I guess you could argue that the banks, building societies and payments firms were unlikely to say, yes, we did it for this reason, because there are specific rules against debanking people because of their political views. Yeah,
I mean, if this review, this investigation was obviously rushed out post the Farage allegations. Do you have any sympathy for the FCA here? Have they been put in a bit of a spot?
They have, because I guess they were ordered to do some work very quickly that would normally take a much longer time. I mean, if you think about it, the FCA is also doing a broader piece about banks' treatments of politically exposed persons generally. That work started in June and will last until next June. It's a 12-month exercise. This was effectively a 5-week exercise done under a lot of political pressure to find a certain answer to a question. And what the FCA are saying now is, well, we haven't found the answer that I think the politicians hope that we would, and we're going to do further work. I mean, what the work did usefully expose was there are some weaknesses in terms of how firms collect this information. Firms don't all collect it and record it in the same way. And I think the FCA certainly can usefully do some work here where they can say, OK, these are the definitions of what we consider, to have rejected on this basis. These are the kind of records that we want you to keep of that, so that when the FCA does further follow-up exercises, they can be more forensic. The other important thing to stress is this is over a 12-month period. It's a very short period. The FCA are planning to do more work on this data, but they're not planning to do a look back at this point of like what's happened over the last decade or so. And when you think about the politicians complaining about the treatment of them, their families, none of them have been specifying that this only happened in the last year. So I think if you're talking about a 12-month period, it's a very small amount of time. Also, 34 firms, there are hundreds of banks in the UK. 34 firms is quite a small number of firms as well.
Just to pick up on something you said, that you appear to be hinting that the FCA is going to carry on raking over this in the hope that they are going to find something that the politicians wanted them to find.
I think they would like to have a more robust data set to defend. I don't think that they're particularly hoping for to get to where, I mean, I think there was a comment in some of the comments around this today that like trying to regulate is not a popularity contest. So they're not going to just try to fill the hole that the government wants them to fill. I think what they would very much like is to have a more robust data set that they can stand over, because I did get the feeling they were distinctly not comfortable with the quality of this data. And banks use different definitions. There were gaps in the data. They refer to it being compiled at speed. So I think they would like something more robust. And they'd also like to be able to show they have influenced something. So if they can make hold banks' feet to the fire, make them properly account for this, maybe go in to audit it, then they can say, OK, we are confident. Because the one thing the banks didn't say, The one thing that the FCA didn't say today was, we are confident this didn't happen. What they're saying is, we couldn't find evidence to prove it happened. It's quite a different thing.
That's a good point. I mean, the other thing they're looking at is the fact that 1.1 million people don't have a bank account in this country. I mean, arguably, that's probably an even bigger scandal, isn't it?
So I think the thing that got hidden in all this, because we've all been so focused on the Nigel Farage question, ourselves included at the FT, there was also a very disturbing stat in it showing that these basic bank accounts, which are the ones that the biggest banks offer to the most vulnerable who can't get other bank accounts, they found that one institution is turning down 35.7% of applications for basic bank accounts, which is an incredibly high figure, and that's something they are going to probe, because the idea of basic bank accounts were, unless you are an active criminal or an active drug dealer, like these are the ones that anyone coming out of jail can get. You know, these are the ones that are meant to promote financial inclusion, to bring everyone into the system in some way. And the fact that you can have a rejection rate at over 33%, and that is really astounding. And if it weren't for the Nigel Farage situation, I think we'd all be talking a lot about that today.
It's very interesting. The FCA also put out some examples of how other countries look at this issue. Is there anywhere out there you could say represents best practice that the UK could learn from?
It's a difficult one. I mean, every country has a different dynamic as well and different kinds of institutions. So I didn't see anything I thought, my God, we should really do that. I mean, the FCA has talked about, you know, access to bank accounts for businesses. They talk about having better auditing of some of the company's accounts, information. That's something that they'd like to see. There's also some work around digital identity, which could help. And there are some countries who are very progressive on digital identity in particular. That might actually help some of the financial inclusion piece. That's probably an area to be looked at. But once again, more for government than for the FCA themselves.
Laura, closing thought. Nigel Farage has called this report from the FCA a whitewash. What do you think?
I think that's probably unfair. I think it is a very limited exercise, but that's not the FCA's design. It's limited by the availability of data and by the very short amount of time they were given to do it.
All right, got to leave it there. Great to see you this afternoon. Thank you. Some other business news stories for you now. And BP today named Kate Thompson as its Chief Financial Officer as part of the management reshuffle sparked by last week's shock resignation of its Chief Executive, Bernard Looney. She takes over from Murray Auchincloss, who's become the interim Chief Executive following Mr Looney's departure. Ms Thompson, who's been with BP for 19 years, had been Senior Vice President Finance for Production and Operations, having previously been BP's Group Treasurer and Group Head of Tax. Well, Mr Auchincloss said today, Kate brings deep technical knowledge together with a detailed understanding of BP and has a first-class track record of leadership across our finance function. Shares of Kingfisher have fallen by more than 11% today after Europe's biggest do-it-yourself retailer warned that profits for the year will be lower than expected. The owner of B&Q and Screwfix said profits for the year are now likely to be around £590 million. That was down 7% on its previous forecast. Well, Kingfisher was reporting a pre-tax profit of £317 million for the 6 months to the end of July, down 33% on the same period last year. It blamed weaker sales in France and particularly in Poland. By contrast, like-for-like sales in the UK and Ireland were up by 1.7%, with Screwfix doing especially well. And American car workers are set to step up their strike action as their stoppages moved into a fifth day. The United Auto Workers Union, which has some 389,000 members, said it would target more plants this Friday unless serious progress was made in pay negotiations with the big three Detroit-based car makers, Ford, General Motors and Stellantis. The UAW targeted plants in Ohio, Michigan and Missouri last Friday in what is proving one of America's biggest industrial disputes in many years. Sean Fain, the UAW president, said in a message to members overnight the union was not messing around. Now it's New York Climate Week, where business leaders, campaigners and politicians are meeting to look at ways to speed up the path to net zero. One of the environmental initiatives being discussed is Biodiversity Credits, which help companies invest in nature restoration. Well, it's being launched by Environment Bank, whose Chief Executive, James Cross, joins me now live from New York. James, good afternoon to you here. What are you actually selling to potential buyers?
Well, look, thank you. Increasingly, organisations are really desperately trying to find a way for them to become nature net positive. And obviously, I was at the launch of the TNFD framework yesterday in the stock exchange in New York, and it was packed to the rafters with leading businesses, global organisations around the world who are increasingly looking for a strategic advantage. Their organisations are wanting to be more competitive by reducing their impacts on nature in real time. And TNFD is a brilliant kind of framework for them to do that. But where we step in and help them is actually get into a position in real time where they can be nature positive and also can help unpick some of the damage that perhaps has been done historically. And we do that in the form of biodiversity credits, which we have anchored to a strategic network of habitat banks, where we generate amazing projects for nature and for the environment.
Now, obviously, people are very, very familiar with the concept of offsets. For the uninitiated, what's the difference between an offset and one of these credits?
Oh gosh, this is not an offset. That's a product that we don't ship in terms of biodiversity credits. We have invested over $300 million into creating a network of habitat banks right across England. These are real, tangible projects. By 2025, we'll have 15,000 acres of these projects operational across England. That's the same size as Manhattan, and they will drive improvements in biodiversity by hundreds of percent. We'll see explosion in butterfly populations, water voles, key important species, and all of our frameworks are open, transparent. And the unique thing about our habitat banks is they're all pre-funded right from day one. Local communities have these projects fully funded for their entire 30-year project. Or build costs, management costs, inflationary costs are locked together, locked away in a bonded bank account. So there is absolute certainty that these projects will be delivered, communities will benefit, nature will benefit. And it's very, very different to that kind of carbon offsetting model. So here, your frameworks like TNFD and others, very, very important at helping organisations secure their future, secure their competitive position in the future by reducing real-time impacts. What we're about is helping them get into a position where they are net positive for nature.
And what denominations are you selling these credits in?
Well, you know, we don't actually sell credits. So we provide credits, but what we allow organisations to do is to purchase an equity stake, a biodiversity equity stake in these projects. So they can buy 10%, 15%, 20% entitlement for the entire 30-year lifespan of that project. Their people, their customers, their clients can see in real time that growth in that biodiversity share. So that's what we're interested in. We can convert it into biodiversity credits, but what's important is actual on-the-ground benefit for communities, for nature, for biodiversity. And that's one of the key things that's emerged here in Climate Week New York is you don't get to net zero without nature.
And what's the typical size of a project that these credits are supporting?
Well, you know, we've got a really exciting project in the south of England, which is about the size of 2 central parks. This project is fully funded. We'll be launching it shortly around Christmas time, and again, this will see nature teeming with snipe, with barn owls, with otters, tangible, real. You can touch it, you can see it, and that's one of our habitat banks that we have being rolled out at the moment across England.
And would you expect over time a secondary market to develop in these credits?
Possibly. I think that's likely. I think that the reality is this is a report last week by McKinsey has estimated that this market is a $1 trillion a year market. I mean, these are big numbers, big opportunities. The key aim and one of the key things that Environmental Bank are interested in really showcasing, it's why we've been invited here to New York, is we think this is a new blueprint for nature restoration for future generations. And I think by harnessing the power of private sector finance, you know, really encouraging governments and regulators to perhaps look at this brilliant case study in England and in terms of sort of some really insightful policy, which has really thrown open the doors in England to private sector investment. It's a big game changer in England. I think the more we can replicate that worldwide, I think there's a big opportunity for investors, for communities, and most importantly, evolve for nature.
OK, James, got to leave it there. Good to talk to you this afternoon. Thank you.
Thank you.
Still to come here on Business Live. We're going to have a look at how the markets have been doing this Tuesday afternoon. Don't go away.
we arrive. A secret hospital hidden in the Myanmar jungle, treating the victims of this bloody war.
This is hardcore emergency medicine in the hardest of circumstances. So you'll be doing brain surgery today? Maybe.
Here, the resistance lives or dies.
It's been quite remarkable. You have to see these things, but banking hurts when you do it.
I'm Inzamam Rashid and I'm Sky's North of England correspondent, telling stories from this culturally rich region I call home.
It's going to become very similar to other places and lose its unique qualities.
It's steeped in history.
If the Taliban found your family, what would happen?
I think they're just going to straight away execute them.
There are issues of racism in all levels of cricket.
I was on the balcony a couple of times. I was nearly gone.
Football is a joy to watch, and when people are disappointed, you can feel the hate.
I just felt physically sick, so I was like, that's really in my system.
We take you to the heart of the stories that shape our world. Even before the pandemic, GPs were pleading for help. Government expects more face-to-face contact with patients in return.
Men, they want to force you doing something which you don't want to do, just because you're homeless and you're looking for a warm place to sleep.
We give a voice to communities often unheard and unserved from a region with a distinct history and global impact.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Well, the oil price has hit a 10-month high today for the 7th consecutive session. A barrel of Brent crude earlier touched $95.96 a barrel. That's the highest since the 14th of November last year. It's currently changing hands at $95.42 a barrel. That is just over 1% higher on the session. In Europe, well, markets have traded in mixed territory there. The DAX in Germany letting the side down rather. It's fairly been quiet, to be honest, really, ahead of the Federal Reserve interest rate decision tomorrow evening. Here in London, the FTSE 100 has just about eked out a gain there, with gains for the oil majors offsetting declines elsewhere. The FTSE would have actually finished in negative territory without the gains supplied by BP and Shell. Those two have added 10 points to the index on their own. In percentage terms, the leading gainer was Hargreaves Lansdown, up nearly 5%. That was on the back of a trading update earlier today. Other FTSE gainers include Phoenix Group, the CEO, of course, on the programme this time yesterday. They had the results out yesterday. Shares finished 1.5% to the good. Meanwhile, Ocado is another company updating the market today. Likewise, that's finished ahead by 1.5%. To the downside, well, I mentioned them earlier in the programme, Kingfisher finished off 12%. That's an absolute shellacking for that stock. Over on Wall Street, the main stock indices open to the downside ahead of tomorrow night's Fed meeting. Things are pretty quiet, it has to be said. Arm Holdings, which we've talked about endlessly over the last week or so, well, that's currently trading to the downside for the third consecutive day, but it remains above its IPO price for now. On the foreign exchange markets, well, again, it's really all eyes on the Fed tomorrow evening. Not a great deal going on there. Sterling more or less unchanged against the dollar, slightly ahead against the euro, about 1/10 higher. Single currency off 1/10 against the US dollar. Well, joining me now is Laura Fole. She's UK Equity Income Fund Manager at Janus Henderson. Good to see you, Laura. Kingfisher really is that's a lulu of a profit warning.
Well, interestingly, it was only a 5% downgrade, so nowhere near as much as the shares fell. I think the UK market, we're all aware that sentiment towards UK equities is not particularly strong at the moment. So when a company downgrades earnings, as it did today, it's not taken well in the share price. Interestingly, it wasn't actually UK trading that disappointed. It was continental Europe. So I think it almost caught investors off guard because people have been worried about the UK. Obviously, the weather's not been great over the summer. But actually, it was predominantly Poland that was the cause of the earnings downgrade. So it caught people by surprise. And again, investors don't tend to like surprises, hence the share price reaction.
No, I mean, Kingfisher, it's also the fact that they've really talked up Poland so much over recent years. It's one of the few foreign markets that they remained in when they did this big retrenchment a few years back.
Exactly, and it had been a key beneficiary in terms of market share gains over the last 18 months or so. But I think it's a classic case of people were focused on one market, the UK, and even though Poland's a smaller market, if the profits fell 2/3 reported today in Poland, and it just shows you can be looking one way and actually it's the other way that catches you off guard sometimes.
Yeah, absolutely. Now, what about Hargreaves Lansdown? Again, a company that's had a lot of issues over recent times. Pleasant surprise today, really.
So you're right, it's a competitive market for these platforms. Fees are under pressure. The results today look perfectly good in terms of revenues, profits being slightly above expectations. I think if there were to be a point of question around the results, it's how much money they're making on client cash. So a very similar debate to what we're seeing at the banks. With how much of that interest rate rise are you passing on to your clients? How much of that is fair? So there's always this quibble, exactly as we're seeing with the banks, very similar debate.
Yeah, and they did make that clear in the statement, didn't they? A lot of investors are sitting on their hands and not trading right now.
Exactly. Whereas actually the active savings product provided by Hargreaves Lansdown, where you can effectively shop around for your savings accounts, is doing very well. That continues to be a successful product for them.
I've talked a lot about the Federal Reserve, which is tomorrow evening, but obviously on Thursday we get the Bank of England. Another quarter point nailed on, in your view?
Arguably the most difficult decision they've had in quite a long while, because there's really conflicting sets of data for them. So if you think about the oil price, as you mentioned, that's going the wrong way. That's going to be a headache for them. And wage growth that we saw recently, we're talking wage growth of over 8%, albeit there's a few one-offs in there around pay settlements. But on the other end, you've got unemployment ticking up, okay, from a low level, but it is ticking up. Vacancies going down. We saw some difficult PMI data. So you've got a really balanced decision, I think. I think it can go one of two ways, and I know that's not answering the question. I think they either say, look, we put up rates 0.25%, and then that's it for now, or they say, look, we pause. And I think this might be, if I were to guess, I think it's this way. I think they say we pause, we wait for more data, but don't rule out further rate rises. And there's inflation data, remember, in the UK tomorrow for them to be looking at.
Yeah, I mean, that would be quite a bold move, given that we're probably going to see an uptick in the inflation figures tomorrow.
Exactly. It is a bold move, but that doesn't mean it's not the right thing. I think we do have a very uncertain situation at the moment. Inflation will, you're right, it is likely to tick up tomorrow because of the oil price. But then come October, you get the hurdle rate of the energy price cap rolling off from last October. So in October, inflation's likely to be heading back down again. So that will give them a bit of a breather, I think. So you're right, it's a difficult call, and perhaps more challenging by the fact that they could have been seen as late to the party in terms of the rate rises last year. So perhaps a bolder call, but that doesn't mean it's not right.
We won't hold you to it, Laura. It's all right. Good to see you this afternoon. Thank you. Just before I go, a bit of breaking news to bring you. While we've been on air, Britain's long-awaited online safety bill, which governs social media platforms such as Facebook and YouTube, has finally been ratified in Parliament and will become law. The Department for Science, Innovation and Technology said the government was now within touching distance of delivering the most powerful child protection laws in a generation. A very long-fought battle to get that bill through the House of Commons. Obviously, that's it from me for tonight. I'm back at 11:30 tomorrow. Very, very busy day. We've obviously got the inflation figures, as Laura and I were just discussing, first thing in the morning. And then, of course, tomorrow evening, the latest interest rate decision from the US Federal Reserve. And we'll be looking ahead to that this time tomorrow. In the meantime, do stay tuned. Coming up after this short break, it's the News Hour with Mark Austin. Have a good evening. Hope to see you tomorrow. Cheerio.